Great, you are welcome to today's discussion. I'm happy Prof is around so we can always chat this together. We will be looking at technical analysis as a tool, basically, is what we'll be looking at. And somehow it is not different from what we've been discussing in the last two episodes. Just a different title, so it could give us a tilt. But in the SimplyPips family, we, especially when we do a mentorship program, which we call the fostering program, we spend so much time on the individual trader and not so much on technical analysis. And then at the end of today's discussion, you would know why. But let's go to the topic, technical analysis. First, what is technical analysis? I went to Investopedia to see their erudite definition of those words. And it reads something like this. Technical analysis is the trading discipline employed to evaluate investments and identify trading opportunities by analyzing statistical trends gathered from trading activity, such as price movement and volume. So for them, it is a trading discipline. What it does is that it evaluates investments and identify trading opportunities. We'll dig deep into them. But the basic thing is that it does all of this using statistical trends. And when you hear the word statistics, what should come to your mind is history. You can't have a statistics technically of something that hasn't happened, right? You could extrapolate into the future, but for it to be a statistics, it has to be something that's happened in the past. So analyzing statistical trends gathered from trading activities such as price movements and volume. So basically, in simple term, trading analysis is a tool employed to, or a skill employed to evaluate investments and identify trading opportunities in price trends and patterns seen on charts. It basically believes that past trading activity and price changes of a security can be valuable indicators of the security's future price movements. So in simple terms, people believe that what has happened in the past could happen now. And this cuts across several fields of human endeavor. If somebody has been suicidal in past, there's a belief that that person could be suicidal in future. If somebody had committed a theft in the past, that person becomes a prime suspect when something of such nature happens. We are within the vicinity where the person can be spotted, right? So it's believed that what has happened in the past can repeat itself. At a later podcast, when we discuss price action, and not price action as in the present definition of price action as in candlesticks, we will look at how theories that tend to prove that you could determine the mass behavior of traders by looking at the candlestick, right? So when you get an inside bar or a doji, it could be signifying the mass indecision of traders, right? So when you look at charts, basically, what we're trying to look is past trading activity and price changes of a security. And we believe that those activities of the past are valuable indicators of the same security's future price movements. Of course, there's been an age-long battle of contrasting between fundamental analysis and technical analysis, and which is stronger. But technical analysts broadly believe that fundamental analysis, which could be part of the company's financials and other things that could affect the asset has been, embedded in the historical price patterns of such a stock or asset. So largely technical analysts may not look up so much to fundamentals. If you see people trading off the higher time frame, I was in a webinar this morning, and somebody was talking about he made over $2 million from January to now, and within trading partly from, I think largely from crypto, if I'm right, Prof, because from crypto invested more in the China stocks, which are basically just at break even now. So it was largely from crypto. And he explained how sometimes he looks at the market from the weekly time frame. And at that level, every small fundamental movements, like if you're trading Euro USD and you're looking at it from the weekly, if there's going to be NFP, whatever, or one Friday, one Thursday, it isn't going to make much of a difference. There has to be a macro fundamental event to move price to the point that it becomes significant on a weekly time frame. So meaning that that supports why some technical traders feel that if I dig deep into my technical analysis, I could as well just do away with fundamental. I don't want to side anyone. We're discussing technical analysis. The argument has been there before I was born, and I believe it's going to be there much longer after I'm gone. So in general, technical analysts look at the following broad type of indicators, right? They look at price itself. Price itself. When I say price, I'm talking about either candlesticks or bars or Renko bars or whatever it is, or Hikinashi. They are all price itself. They look at price. And they try to understand price. And at this junction, I must say that technical analysis is a tool, and I could use other synonyms for tools here, and I could say it is a language. Is a language. If I draw an Elliott wave, a simple Elliott wave of A, B, C, D, E, F, something like that, practically anybody who understands technical analysis will tell you this is an uptrend. Whether they are Chinese, Jewish, Arabs, Africans, Jamaicans, they will say this is an uptrend. If I write something in Hebrew language, in Hebrew letters, and I drop it on SimplyPips, I'm sure several people will ask me, what did you just type? If I type something in Chinese, or in fact, a very common one, because we have so many Nigerians in the SimplyPips community, we use some of our Nigerian slangs. And sometimes you see some of our friends from Europe, Asia and the likes, and they come and say, what's the meaning of this, right? But nobody will ask me what is the meaning of this if I drop an upward trending Elliott wave. Everybody knows that this is an uptrend, right? So technical analysis is a tool, could be said to be a language, and then we'll come back to that later. So people who use technical analysis, they could focus on price trends. They could look at chart patterns. And when I say price, I'm talking about maybe one or two candles, three candles, where we have the inverted doji, the morning star, and the likes. When you put most of those candles, when you put a bunch of candles together over a period of time, it forms a pattern that we could call a chart pattern. So you have things like falling wedge, rising wedge, head and shoulder, inverted head and shoulder, cup and handle, and the likes. Those are chart patterns, right? The common one we use in SimplyPips, we say we have a source, a breaker, we say we have an order block. They are all chart patterns or price trends. Some people look at volume and momentum indicators, right? So some look at different type of volume. There are different type of volume. Go to volume itself is a big topic on its own. Some look at oscillators, and we have very many oscillators, common ones, RSI, stochastics, and the likes. And in fact, there are definition of what an oscillator is. So because something is on the lower part of your chart, doesn't mean it's an oscillator, right? It has some definition. Of course, we have some other trend following indicators. Common ones are like moving averages. Just going to your trading view or your MT4, you basically see them. In fact, MT4 divides them basically into 5. We have trends indicators, we have oscillators, we have volume. Bill Williams, I don't know, that man did a lot that MT4 had to dedicate, something to him.
You cannot classify where Bill Williams is. They
just had to put him in his own category, and MT4 goes ahead to say that we have custom, other things that we can produce, other people created, and then so Prof is very good in dealing with indicators. When I am in gathering of traders, we are some group of traders, of course, people who claim they trade naked chart. When they say ill of people who trade indicators, in my mind, I say, go meet Prof, then you might just have to change your mind on what indicators are. People have been trading with indicators before practically any of us in this call came to the planet Earth, and they've been profitable. So it hints at pride or some form of ignorance to cast aspersion on all of those people and say they are not doing so well, right? So maybe we'll give Prof some time at a later date to take us through indicators. He's done that before, right? So we have moving averages, and very common one, popular moving averages are things like 50, 200, 800. Those of you who trade BTMM, where they use about 5 moving average, and they give them very, very wonderful name, ketchup, mayo, and all like. They are basically just 5, 13, 50, 200, and 800 exponential moving averages. Some use support and resistance levels. Those are also technical indicators. So when something is a resistance, it shows that when price got to a particular level, the combined sentiment of the market was that of a feeling that that price is too expensive, and then it sold off, right? And then it sold off. So the tendency that when price returns back to that level, it might instigate the same reaction it did previously. Again, notice that in technical analysis, we're trying to put some things together to interpret what has happened in the past, and by that, we're trying to forecast what will happen in the future. Now back to the main discussion for today. To master a specific method of technical analysis, it's imperative that the user understands the boundaries of the chosen method of technical analysis. Every method of technical analysis has boundaries. And by boundaries, I mean when it fails, when it works best. For instance, it might defeat the purpose of using trend lines, which are basically technical analysis. 2, it might defeat the purpose to use trend lines in a ranging market, right? Because from the name trend, it should be trending. So if you use trend line in a ranging market, somebody who understands technical analysis, maybe better than you, might just be wondering what you were doing. So when I say boundaries, I mean where it fails, when it works best, its edge, what is the edge it has in the market, when it presents a setup, you have to be able to identify when it presents a setup and separate it from when it presents an entry. You know, then of course you have to be able to gauge if it is applicable to your personality as a trader. For instance, when I started out trading, I toyed a little with quarters theory, right? And I struggled a little because quarters theory, same thing with some terms where some people say these are institutional prices, and they try to tell you 0.8, 0.00 and everything. I struggled with some of those things at the start of my trading career, because one day I was talking with somebody, and coincidentally, that was about 2.5 years or 3 years ago. Coincidentally, the person I was discussing with was Dr. Tabor, and he was playing with weekly lines, weekly support and resistance. I can't remember what he called it. So he goes to the weekly, looks for a pattern that looks like it has broken support. He has a way of doing it. Then he now draws a line. And when we tried it out, it had phenomenal, confluence. Several reactions happened at those points in the market. He picked those support and resistance levels from the weekly, superimposed them on the lower time frame, and then we saw reactions on them. When I went back to study it, even though I didn't stay long in that, of course, as traders, we progressed. It brought more confusion to me, not because it wasn't working, but now sometimes those lines fall 15 pips away from my quarter points. And then I'm now wondering which of them we hold, the weekly lines or the quarter points. On Monday, it reacts from the weekly line. On Thursday, it reacts from quarter points. Now I'm confused. I have 2 points, 15 pips away, and they all seem to be strong. So one day I just closed my eyes after I'd clicked on a horizontal line on MT4. I closed my eyes, then I moved my mouse several times, and then I stopped and I applied the line to the chart. Lo and behold, it fell somewhere arbitrarily. Then I went to different time frames, and I discovered that in all the time frames without miss, price reacted at that line at least one time in the past. That brought demystified support and resistance levels to me, and made me understand that if I draw a line on the chart, at one point in time, it would have been a support and resistance. Now, some people may argue that, well, there is a methodology to drawing support and resistance, which I agree. And the reason why I said to master a specific method, you must understand the boundaries, right? But for me, that aha moment, it busted the boundary, broke down the boundary, and it became borderless. And because it became borderless, to my personal experience, support and resistance lines no longer made sense, and neither the trend line, right? So I couldn't find myself applying them, simply because I came in contact with weekly lines, I came in contact with quarters theory, I came in contact with it. I came to understand that if I put a line on my chart, anywhere on my chart, at one point in time, it would have reacted. The same thing with moving averages. I never find it easy to trade moving average as a moving support and resistance, right? I don't care what you call the moving average. Put a moving average of any variation on your chart. Let it be 200-day moving average. It could be exponential, partly weighted, fully weighted, semi-weighted, whatever the name is, divided by whatever. Put it on your chart, at some point in time, price will go straight to the pip to that moving average and reject. Does that make the moving average an almighty formula? It doesn't, right? So you have to know you have to understand the technical analysis you're using. You have to understand the boundaries upon which the technical analysis will perform best. And you can't identify the boundaries by merely looking at the chart. You need to put pen to paper, or well, these days people rarely write. You need to be able to record data, historical data, because by definition, technical analysis looks at history. You need to be able to put historical data together and then interpret the data. Unfortunately, if there is no, I wouldn't say there is a uniform standard for gathering data and then reporting them. Of course, data on its own doesn't say anything. The interpreter is the person who puts meaning into data. And this is even more true if there is no global or organized way of gathering the data. So I'm putting that clause there because even after gathering the data, you might get bias in your interpretation just to make yourself feel good. And then when you get into the market gives you something different because your interpretation was actually different. Now, for your interpretation to look similar to that of the market, you need to be able to identify two things, which is when do you get a setup and when does the setup become a trigger to take a trade. If price bounces off a moving average and it happens, or a trend line and it happens 3-4 times, that could inform you that that point is a strong zone, which you could call supply or demand or whatever. Yes, that's true. It's an information, but how do you interpret it? How do you gather the data? Do you just say price bounced there and then fell? If that is your data, if that is your interpretation of the data, you've restricted yourself to only using sell limits or buy limits. So if price gets there once or twice, and therefore, if your definition of a support is that price must react there twice, then by the third time, by that definition, you need to have set a sell limit for a sell, right? But if your interpretation of the data is that price reacts from those points, but then when it gets there, that is a setup, I then have to look for an entry, and then it means I'll go down to a lower time frame and look for a BTB or an LSB or a breaking structure or a bearish engulfing. Then you've further broken down the boundaries, or narrowed down the boundaries of that technical analysis. And then you might begin to have something that looks like a result that you might be able to replicate in the market. So technical analysis, basically, as I round up, is a tool or a language. And a tool or a language is only as good as the craftsman using it. If I have a crowbar and I don't know how to use a crowbar, the crowbar could be, well, can a crowbar be sophisticated? It could be, an efficient way of doing something. But if I don't know how to use it, the tool in itself could be efficient, but it won't make me an efficient, user of that tool. If I get into a Tesla and I don't know, because I've never entered one before, but seeing it on mobile, on social media, I presume that most Teslas are keyless, right? You can start the ignition without using, a hard key like that. If I don't know what to do to start up the car, I might be in a Tesla and don't move it by 1 inch, right? So it doesn't mean a Tesla isn't a sophisticated tool. It just means that the driver or the person in it isn't, educated enough to be able to use that tool. So technical analysis will not conquer fear. Technical analysis will not conquer hesitation to take trades. Technical analysis will not conquer greed and indiscipline, especially indiscipline with exit points, moving your stops, trailing them when your methodology didn't say you should trail, getting to your TP, but feeling that price will move further and therefore extending your TP only for price to come back and take back some of what it's giving you. Technical analysis will not tell you that. Or rather, technical analysis could tell you that, depending on how you played with the back test, right? But it won't stop you from being who you are. Like the unavailability of a trader taking a trade. You are not available when your setup appears. The technical analysis could be good, but if the setup will usually come around times of the day that you either be asleep or busy elsewhere, then you will not mirror the win rates you would have discovered in history because you are not there to apply that technical analysis. So in our community, especially the SimplyPips fostering program, we play down on technical analysis because we believe technical analysis is just 20% of the whole thing. We try to, in fact, insist that every trader identify personally if a method of analyzing the market suits their personality, right? We insist. It is a disservice for any mentor to insist. That's my belief, and I could be wrong. What do I know? That every trader must trade exactly the same way. I feel it's a disservice because we're practically not wired the same. And if we're not wired the same, we do either of two things. It's either you look for a strategy or a technical analysis method that suits the way you are wired, or you practically rewire yourself. And either of them is not something you could do, at the snap of a finger. It practically takes time. And some people get lucky to find a strategy that suits them, in few weeks, in months, in 1 or 2 years. Some people are not that lucky, right? So technical analysis, powerful tool as it is. You go around YouTube and other trading forum, you see people talking so much about technical analysis. BTMM is a way of looking at of price, is a technical analysis. ICT, no matter what we call it, is a technical analysis method of looking at price, either charts or whatever chart patterns. The use of stochastic RSI, they are all technical analysis. And if you understand the individual components of an indicator, for instance, there is practically no strategy that you can't invent, right? You understand how to use oscillators, you understand how to use momentum, you understand how to use volume, you put them together, you would create a winning strategy, right? If you look back enough and look critically into the details of those tools. So at this junction, I'll give Prof room to lend his voice in some of those things we've said before we begin to call it a wrap. Prof, are you still available?
Yeah, so Bishop, thanks. I think you basically said the key things that need to be said. I like that part that you mentioned towards the end, that every tool is as good as the craftsman that is using the tool. So once we understand the fact that technical analysis is a tool, then we should use it as that. So as a tool, when you have a tool, you need to understand the job at hand. So one of the issues we have with many traders is that we don't understand what we are doing. We don't understand exactly what it is we are looking for. And so it becomes difficult for us to apply this tool rightly. For instance, one of the issues I have with those, like Bishop mentioned earlier, I use indicators a lot. And one of the reasons why I do that was, unlike Bishop that had issues with identifying the fact that you draw a line in your chart and it's basically a support and resistance at one point in time. For me, it was I get lost. It was something similar, but I easily get lost when doing that because I'm like, I can draw like 1 million lines on this chart. So which of the lines exactly do I use? And I would like call it perfection, but I like the issue of if I give this same thing to like 10 people, 11 people, whatever, they will see the same thing. So a situation where we're like, if you give 5 people the same thing and say draw a trend line, you'll see the entire 5 people drawing different trend lines, and all the trend lines they drew are correct. So that was problematic for me. So the issue was, how was I going to overcome that? So in overcoming that, I had to first learn myself. In learning myself that, oh, this is the kind of person I am, I've stopped bothering myself trying to do naked charts. There are some strategies I have that a bit of naked chart, but you know, so when you use those indicators, I know what I'm looking for. So if I go into the indicators and I'm looking for trend, I know exactly what I'm looking for. If I want to see, okay, volume, a lot of people, people use COT and all those things. And I'm like, okay, good enough. And all I do recently is just get one of the volume indicators on there and put a moving average to it. And it's as fine as giving you the average, because moving average basically gives you an average of the last couple of days. So if the average is going up, then volume is going up. It's as simple as that. No need to start doing complex data and all that. So if you understand the work at hand, you will now know how to tailor the tool that you have to solving that problem. So if I want to know what volume is doing, the question is what tool? How do I apply the broad tool sets? So technical analysis is like a toolbox. So in that toolbox, you have several tools. So which tool out of that toolbox? So if I have a toolbox, most of my tools, I left them somewhere else when I relocated. But then I used to have a lot of tools. So if, for instance, I need to bolt a knot, I need a wrench. I don't need at that point. I don't need a screwdriver. All right. So I need to go and get a wrench. I need to get a spanner. All right. So that's the same thing with technical analysis. When you are analyzing the charts, you are looking at trend. What exactly do you need? What do you want to find out? You want to find out basically whether the price is going up or down, or whether it's going sideways. So how do you discover this? You say you're looking at volume. We want to basically look at, is the volume going up or volume going down? How do you do this? So if we begin to understand problem, like we begin to look at trading as answering a problem, like different parts of trading as components of a problem, and we begin to look at our tools, technical analysis as a toolbox, we can look for tools that address the specific issues that we are trying to solve. So if we're looking for trend, we can use so many things. We can use order flow, like what we've been learning. We can use institutional order flow, where we are looking at order blocks and breakers and all that. We can use moving averages. We can use things like the Renko bars, the Fibonacci, and all that. So you basically understand what you're looking for. If you are looking for areas of discounts, premium, and all that, we can use our Fibonacci tools. We can use our oscillators. That's where such things make sense. So by understanding the fact that all these things we are doing, they are all tools trying to solve specific problems, it helps you as a trader to stop, jumping from one place to another. It's not for you to ask yourself, what is the problem I'm trying to solve? And what are the tools? What are the tools available in my toolbox? That's the technical analysis. What are the tools available in that toolbox to solve this issue at hand? I believe as we go on, we'll be able to narrow down into things and really begin to explain them better. Usual.
Right, Prof. So I don't want to make this meeting too long. But I want to wrap up here by letting us know, picking one of the words that Prof said, what do we really want to do? What, as traders, what are we out to do? As traders, for me, my belief is that traders are trying to know if price will go up or down. Basically, that's what we're trying to do. And the next thing is I'm trying to know when is the right time for me to buy. Let's say I've concluded that price is in an uptrend, it's going up. And if price is going up, I should be buying, Forex 101. If I should be buying, then at what point in time should I start buying? What must I see for me to buy? Of course, if you're a business person, you should want to buy when it is cheap and then sell off when it is there. The question is, how do I know that it is cheap? So if you use something like RSI, you'll be looking for when it is oversold in a bullish market. If you use stochastics, you'll be looking for when it is oversold in a bullish market. So you're only buying in a bullish market. If you're using Fibonacci, you're looking for when it is gone below the 61.8 in a bullish market, right? If you're using price action, you wait for when the lower time frame trend has changed to align with the higher time frame trend. And in that case, we're looking for breakers, LSB, BTBs to go into the trade. If you don't understand the components of a technical analysis framework, learning the technical analysis framework will not make you a better trader. Final words from me now. There could be a glut in the minds of traders when they learn more than one technical analysis. And the glut happens because of what Prof said, right? It happens because traders find it difficult to understand the boundaries of each of those technical framework. Prof, can you remember? I've got the name of the other man who said he had over, was it 30 or 50 trading strategies?
Yeah, I can't remember his name now.
Yeah, but you remember he said something like that.
Yeah, he said he has the strategy for almost every single event in the market.
In the market, right? And I'm talking about somebody, we listened to 3 educators this morning. Put the 3 of them together between January and now, they've made close to $4 million US in profits between January and now, right? So these guys are talking real facts, experience. We had to wake up, cut our sleep in half to listen to them. Now, this guy had strategies for every market situation. What I see people do is that you've learned a strategy, and the strategy says, when you see red, buy. And then you get into a ranging market, you see red, you click buy. You get into a trending market, you see red, click buy. You get into a trending market that is bullish, but it's discounting, you see red again, you click buy. You want to use just that one, red is for buy, in all market conditions. So if you hit brick wall once or twice, and then somebody introduces, or by virtue of your desire to improve yourself, you learn another thing. If you don't set a boundary around what you've learned, what you most likely do is discard what you were using before, pick up the new thing you've learned, and try to apply it as a brush on every other market condition. Again, the result is going to be the same. What works as a scalping strategy may most likely not work as a swing strategy. So when people say I've learned 2 or 3 strategies and now I can't trade because when I look at the chart, I'm confused, I simply know that you learned the strategy, but you didn't know the boundaries of the strategy. I have some strategies in my toolbox. When you're looking at the ranging market, you should be able to know, okay, this strategy might just be it. Maybe I can use something like a martingale in a ranging market. Or when the market is trending, martingale is dangerous, right? Or something. We must take up our time to understand that the technical analysis is just a tool or a language. If I am bilingual, for instance, which should be a plus and not a minus. Being bilingual or speaking more than one language should be a plus. But I will be stupid, or permit me to use a lesser word, foolish. Is it actually lesser? If I go to Britain, simply because I can speak French, I go into all the supermarkets, all the eateries, and greet them in French, and then complain that they don't respond when I try to communicate. I will be unwise to do that. Having the ability to speak different languages should put me at advantage of discussing with people from different ethnicity with certain level of ease. But then I must be wise enough to know what is the ethnicity of this person, and then which of the languages I know would make sense to this person. And with that, we'll call it a wrap today. We'll pause this right now and perhaps give room for 1 or 2 questions outside the recording so it doesn't get too lengthy. Thank you guys for coming.